Getting back a little bit to sort of the economics and investing, what I wanted to ask you as a fundamental investor, which is what you are, right? Mm-hmm. So one of the I've basically modeled you in the sense that back in the days, as economists, behavioral finance in the behavioral finance space, we tend to model what we call chartists, which are basically people who look at charts, and they're basically technical analysts, and mostly we assume that they use momentum. So they think if a stock goes up, it will continue to go up, and if a stock goes down, it will continue to go down. If you have, so these are one types of investors that we model. Then we have the Richard of this world. We have fundamentalists, but not just you. We give you superpowers. We give you the power to actually know the actual fundamental value, that is the discounted present value of all future cash flows of that company. And we simulate you with these chartists. But what we then notice is that if we give them a little bit of evolution, so if a fundamentalist does well, there will be more of them. And if chartism does well, there will be more of them because they make bigger profits, which is how markets work, right? Fundamentalists, even though they know the truth, they know everything, they have perfect knowledge, they lose out to quite a few of these chartists. Because they see like, oh, hey, fundamental value is this. But then a lot of chartists enter, and you could compare that to retail traders entering the GameStop saga.
Sure.
And then the price will just go up. And the fundamentalists, they know that's not correct. So they will start shorting. But of course, they will get annihilated. So I was wondering what you think about that way of looking at markets as a fundamentalist trader.
And I think there's some truth to that where... I genuinely, my own view is that GameStop and all that shows a lot of the why it's so complicated to do purely fundamental analysis. Because if especially in the short term, I would say market efficiency doesn't exist within a 12-month period. is kind of my own. There's some degree of it. If a company posts good news, it will generally go up. Mm-hmm. But there's so much influence in the short term. And really, when you understand how a lot of brokers and investment banks trade positions, you can see that a lot of the volume of share trades doesn't have a whole lot to do with fundamental factors. So, there might be a large institution that's trading based on technicals or whatever have you, or quantitative variables. And if they buy for reasons that have nothing to do with fundamentals, then all of a sudden the fundamentals aren't predicting where the stock price will go.
Yeah.
I think where I reconcile that is looking more longer term, because the fortunate thing about stocks is that for many companies, not all companies, but for many companies, the stock price doesn't mean a whole lot to their operational performance. It's not always the case. There are plenty of companies that continually issue shares, but there are some companies, more value positions, that actually benefit from a lower stock price. And in fact, not to recommend oil and gas companies, but one thing, for example, that you're seeing in that space where stocks are so cheap, if you just look at a simple ratio, you could say that oil and gas is cheaper to other industries. What a lot of these companies are doing is buying back their stock. And that's actually a very easy method of returning capital to investors is, hey, if the public market doesn't want to give you a fair price for your stock, then buy back your whole company. It's an easy use of your capital. And it's, if you truly believe that your fundamental worth is higher than what the public market is granting you, then you can get a very good deal for the shares you have outstanding. So fortunately, for companies that aren't issuing shares, there's not a whole lot of pain that comes from having a low stock price. And their operations likely won't be impacted materially. Now, there is sort of this kind of counterintuitive side of it where a company like GameStop, for example, might be in business today solely because its stock price skyrocketed. Because GameStop issued more shares and took advantage of that, and basically raised capital at the expense of investors, because all of a sudden, their stock price is worth a heck of a lot more.
Yeah.
Well, they can get a lot more for their stock if they sell stocks directly to public investors. So it's not to say it doesn't matter, but if you believe in your company and you're in it for the long term, then the volatility of a company's stock fortunately doesn't impact the underlying business very much. Which means that, again, if you truly believe in the position over a 10-year period or longer, then you should be able to find, even if the stock price doesn't move a whole lot, the company can pay dividends, which is just passing along the underlying profit to investors. it can buy back stocks, which leads to a similar effect to dividends. Because even though it might not seem like it, it is returning capital to investors and giving the remaining investors more of the company, if you will. So it's sort of similar to a stock dividend. It's not perfectly the same, but so that's where I would reconcile it. Is in the short term, I would agree.
Yeah.
I think short-term trading based on fundamentals is kind of a loser's game in my opinion, because there's just so many variables that are not fundamental or efficient.
Mm-hmm.
So, you could have a giant hedge fund. It was a family office actually, Archegos, I believe, or it was one of the big family offices that went bankrupt and brought a bunch of stocks down with it. That has nothing to do with fundamentals, and yet it dragged down the stock market because a hedge fund failed. Sorry, family office, not a hedge fund technically. But
although it does have a little bit to do with fundamentals, though, right? Because the how the market operates is also part of the fundamental value of that company, perhaps. But maybe I'm taking it too far. But it's at least not. It's not technical analysis.
It's not technical, and you have a good point in that there is a fundamental aspect to it in the sense that you could argue that, say, capital markets are now more difficult because this company has gone under or whatever have you. There is some fundamental impact there. I would say that likely that selling activity depressed stock prices by much more than that fundamental impact on those businesses. Even though this family office is selling these shares, the impact to the underlying business was probably pretty muted in the grand scheme of things. Again, if you take a company that's not raising capital, they're not really impacted by the state of capital markets, at least in the short term. If they're not, obviously they have long-term loans and things like that. But yeah, so that's where I reconcile.
Okay.
It's kind of the time frame.